Welcome back to Talk Pickers, your essential briefing on the latest market-moving earnings calls.
Hello.
Today, we're doing a deep dive into the Molson Coors Q3 2025 conference call.
Right. And this one felt pretty significant, different.
Absolutely. It really marks a crucial leadership shift. We've got the new CEO, Rahul Goyal, officially taking the reins now.
And stepping into, well, let's say a challenging environment, that's putting it mildly.
Yeah.
You had these significant macroeconomic headwinds really hitting consumer spending.
Especially certain groups, right?
Exactly. And then layered on top, you've got this constant pressure from input cost inflation. So, yeah, this call was less about celebration.
And more about resetting things.
Totally. Resetting expectations, laying out a new strategic direction.
Okay, so that's our mission for this deep dive then. We want to unpack that financial snapshot, which confirmed the tough environment.
Right.
Then analyze the big strategic reset under the new CEO.
The impairment, the guidance.
Exactly. And detail that critical guidance refresh, where they, really told us where they expect to land for the full year 2025.
So let's start with the numbers.
Let's do it. The financial snapshot.
Okay, so looking at Q3, the figures definitely show that soft market we talked about. Molson Coors reported $2.97 billion in revenue.
And underlying EPS.
$1.67. Both of those numbers were actually slightly below what analysts were expecting.
Consensus miss. Okay.
Yeah, and net sales declined 3.3% on a constant currency basis. So, not great headline numbers.
But what really stands out to me and maybe tells a different story is how the market reacted.
Ah, right. The stock action.
The stock closed the day higher, up about 1.0%. And the trading volume was huge, over double its daily average.
So the market was braced for something worse.
Exactly. It seems like everyone was expecting really bad news. So when the guidance wasn't slashed even further, there was this sort of cautious relief rally.
Shows you just how low expectations had sunk going into the call.
Totally reset.
And that pessimism wasn't completely unfounded. Management shared their internal estimates. They think the total U.S. beer industry volume was down something like 4.7% for the quarter.
Wow, 4.7%. That's a pretty significant contraction.
It really is. And it provides that crucial backdrop for why Molson Coors' own numbers were soft.
Okay, let's move on to, the elephant in the room. Beyond just the operating result.
The huge non-cash charge.
Yeah, massive. They recorded partial impairment charges, goodwill first, totaling about $3.65 billion.
Billion with a B.
Billion with a B. And then another, $274 million for intangible assets?
So nearly $3.9 billion all told. This is that classic clearing the deck move you often see.
When new leadership comes in during tough times.
Exactly. I mean, it's non-cash technically, but it's a really powerful signal. It basically says, look, our prior long-term financial hopes for this business.
They don't match reality anymore.
Precisely. They don't align with what management is now calling the slower category realities of the U.S. beer market. It just wipes the slate clean, takes the hit under the new CEO.
Absorbs the pessimism, basically.
Right. And that reset flowed immediately into the refreshed guidance for the full year 2025.
They kept the original framework, but big but.
Big but. They explicitly guided to the low end of all the prior ranges they'd given.
So what does that mean in numbers?
Okay, so net sales decline, now expected to be 3% to 4%, constant currency.
Okay.
Underlying pretax income decline of 12% to 15%, again, constant currency.
And EPS.
Underlying EPS decline of 7% to 10%, low end across the board.
So what pushed them to that low end? What were the specific drivers they called out?
Very specific, actually,
Yeah.
And heavily focused on costs, particularly inflation. Management flagged that continued exposure to the elevated Midwest aluminum premium.
Ah, the cans. Always the cans.
Always the cans. They'd initially assumed a range like $1.60 to 75 cents per pound for that premium.
Okay.
But in Q3, it trended right at the high end of that range. And critically, in October, it was actually slightly above that range. Hit an all-time high, apparently.
Wow. So that one factor alone
has a big impact. They quantified it. It implies an unexpected annual cost burden exceeding their prior estimates by somewhere between $40 million and $55 million, just from that one input cost.
That feels like something that might be sticking around. Is it becoming structural, or do they see it normalizing? Did they talk about that?
They definitely stress the volatility, the current cost environment, especially logistics and that Midwest premium. It's just really unpredictable.
So they're baking in the high-end risk for now.
Seems like it, for planning purposes. And on top of the cost side, they also adjusted their inventory expectations.
Okay, how so?
They now expect Lower year-end U.S. distributor inventory levels compared to last year. On an absolute basis, that is.
Lower absolute levels. And that means shipments trailing consumer takeaway in Q4, STWs versus STRs.
That's exactly it. So they're saying days of inventory will still be healthy. The channels won't be dry.
But they're shipping less in than what's selling through.
Right. So reported volumes in Q4 will be negatively impacted because shipments, the STWs, will lag behind what consumers are actually buying, the STRs. It's a temporary financial headwind, basically channel management.
Got it. Okay, so this brings us nicely to the strategy pivot. This felt like maybe the most important part of the call, right? The new CEO, Rahul Goyal, laying out his vision.
Definitely the most consequential part.
Yeah.
He introduced this idea of a distinct barbell approach.
Barbell. Okay.
Which is really an explicit acknowledgement that, look, in this pressured environment, you have to win at both ends of the price spectrum. You can't just focus on one.
Makes sense. They have to react to that category contraction you mentioned earlier.
Exactly. So the barbell has two main focuses, two ends. First, fortify core economy. Meaning prioritize the big, iconic, high-volume brands like Miller High Life, Keystone Light. They basically said, look, macro pressure is hitting lower-income folks, is hitting Hispanic consumers hard. Value matters right now. Maybe more than ever.
Can't ignore the core. Okay, and the other end of the barbell?
That's about leaning hard into above premium and beyond beer. Areas where management admitted the company currently under-indexes in the U.S. market. They're underweight there.
So trying to capture that growth, too. Any specific examples they highlighted?
Yeah, they gave a few. Peroni seems to be doing really well. Q3 volume was up 25%.
25%, wow.
Yeah. And they see a lot more room to run there because its distribution footprint is still only about 1/3 of its main competitors. So lots of white space.
Okay, Peroni. What else?
In Beyond Beer, they talked about leveraging their distribution muscle. The Fever Tree U.S. deal, for example, is apparently performing strongly.
Right, using their trucks.
Exactly. And brands like Topo Chico Hard Seltzer are gaining share in key regions.
But it wasn't all positive on the premium side, was it? I seem to remember a weak spot.
No, you're right. Good point. The core Blue Moon Belgian white brand is still challenged. That kind of underscores that not all established premium brands are firing on all cylinders right now.
Interesting. Even within premium, there are winners and losers.
Definitely. Though they did say they're finding some success with Blue Moon extensions, like the non-alc version and the high ABV ones.
Okay. So to make this whole barbell strategy work financially, they also talk about efficiency, right? Cuts.
Yes. They announced an America's restructuring plan. It involves reducing salaried headcount by about 400 positions.
Which is
roughly 9% of the salaried workforce in the Americas region. So pretty significant.
That does raise the question, though. Why make cuts when you're saying you need to invest in growth?
But that's the key point they stress. It's about immediate redeployment. The savings from this restructuring, they aren't just dropping to the bottom line to make the P&L look better short term.
They're being reinvested.
Immediately reinvested. They basically created a growth fund financed by these layoffs.
Right.
Funneling that money straight into commercial capabilities, supporting key brands, and improving the supply chain and technology.
So a stark trade-off. Get leaner to fund the future.
Exactly. Leaner, more agile, that was the message. Designed to fund that barbell strategy.
Okay, let's shift to investor context. Capital allocation, always key for staples companies, right? What was the message there?
Message was stability and confidence, essentially. They stressed their commitment to the dividend. That's crucial for income investors.
And buyback.
Importantly, yes, they announced they'd restart the share repurchase program immediately, right as the trading windows reopened.
Sending a signal.
A strong signal. Management explicitly called the stock a compelling investment at current levels, putting their money where their mouth is, so to speak.
What about M&A acquisitions?
Cautious but open. That was the vibe. They emphasized capital discipline, first targeting 2.5 times leverage, keeping that investment grade rating. That's paramount.
But
the new strategy is receptive to scalable deals that can fill gaps in their portfolio.
Any specific gaps mentioned?
Yes. Rahul Goyal specifically flagged RTD spirits, ready-to-drink spirits, as a current gap they're keen to potentially fill.
Interesting. So targeted M&A is possible.
Possible, but they were clear. They won't just chase top-line growth for growth's sake.
Yeah.
Any deal has to be smart, prudent, accretive.
Okay, so summing this all up for the listener, what's the big picture takeaway from this quarter?
I think it's really the story of a necessary and pretty aggressive transition.
Yeah.
That almost $4 billion impairment charge, the restructuring that's them laying the groundwork. setting a new foundation.
Focusing the company on what? Measured progress?
Yeah,
Cash generation?
exactly. Measured, disciplined progress, generating cash. Not trying to pretend the U.S. beer category is going to suddenly bounce back strong anytime soon. It's about navigating the reality.
Sets a new, maybe more realistic floor for 2025 expectations.
I think that's a good way to put it. A realistic floor.
All right, now let's transition into our regular segment. This is not financial advice.
Where we get a bit creative.
Where we pitch an outrageous but plausible trade idea based purely on what we heard on the call.
And the usual very important reminder. This is strictly for entertainment and discussion. It is absolutely not professional financial advice.
Please, always consult a licensed professional before you even think about making any investment decisions.
Okay. Disclaimer done.
Right. So here's the setup for our hypothetical hedge fund analyst briefing. The single most specific, quantifiable pain point management cited for guiding to that low end
Was the aluminum premium, that Midwest premium cost.
Exactly. Unexpected cost exposure there. So our trade thesis, the aluminum premium short hedge.
Okay, unpack that.
Management admitted the premium hit the high end of their own assumed range and then went even higher, hitting an all-time peak in October.
Right.
This suggests that maybe, just maybe, their current calculation for the full-year headwind, that $40 to $55 million figure, might still be too conservative if these macro pressures, these cost pressures, intensify further.
So the bet is things could get even worse on the cost side than they've guided for.
Potentially. So the pitch is this. Short Molson Coors common stock. The thesis being that these relentless cost headwinds, mainly from aluminum tariffs and that premium, could erode margins faster than the restructuring savings can offset them.
Okay, that's the short side. What's the hedge?
Simultaneously, you buy call options on aluminum futures, or maybe a relevant aluminum ETF, as a partial hedge.
Ah, so you're betting the input cost itself stays high or goes higher?
Exactly. You're betting that this aluminum cost pressure isn't just cyclical, it might be more structural, and it's going to keep punishing companies like Molson Coors that rely heavily on cans, especially if they struggle to pass those costs fully onto that value-conscious consumer they're targeting with one end of the barbell.
So the spread between the short stock and the long aluminum calls tries to capture that specific margin risk for the company.
That's the idea. It's a way to play that very specific pressure point they highlighted.
Provocative. Leverages a very specific data point from the earnings deck, for sure.
All right, so just to quickly recap the quarter before we wrap up, Q3 missed consensus estimates.
But maybe more importantly, it gave us this clear strategic plan for a portfolio reset, that barbell strategy.
Coupled with those aggressive cost cuts that are meant to immediately fund future brand investment.
And that huge impairment charge is really the anchor of this whole transition. It's management saying, okay, this is our new revised view on the true structural growth potential of the beer category.
Right. Which leaves us with one final thought for you, the listener, to maybe explore further.
Okay.
Given that huge $3.9 billion non-cash impairment charge they took this quarter, how should investors value the goodwill that's still on the company's books?
Has the market fully priced in that slower category reality the impairment represents?
Or is there maybe still some further structural risk lurking in the U.S. beer category that the current stock price might be ignoring?
Something to definitely mull over as you analyze the beer industry heading into next year.
Absolutely. Thanks for tuning in to Talk Tickers.
We'll catch you on the next one.
We'll be back soon with more deep dives into the financials that matter.